Hi guys, this is Jake with Jake Jones Finance, and today we'll be going over the stock market for beginners in 2026. If you do like the video, feel free to leave a like below. Also, feel free to leave a comment in the comment section below, any questions or comments you might have. If you do enjoy the channel, I post investing content, personal finance stuff. If you're into that kind of stuff, feel free to subscribe. Without further ado, let's get right into it. This video is being recorded in January of 2026, and it's really for people who just want to get started in investing and just investing in the stock market. And maybe you don't know where to start or really know what it is. So let's take a look at what a stock is. A stock, also called equity, is when you have partial ownership in a company. Not all companies sell stock, only public companies you'd be able to actually buy stock from. Private companies, on the other hand, you wouldn't be able to. The reason companies sell stock is because they need to raise capital, right? These are usually bigger, larger companies that want to make more money from you investing into the company. If the company does well, then your slice becomes a little bit more valuable. But if the company does not do super well, then your slice will go down in value. And that leads us right into what really makes a stock price go up and down. So, just to be clear, stock prices move purely on supply and demand. The more people buy, the more the price goes up. The more people sell, the more the price goes down. It's important, too, to not worry too much about the actual price of a stock. For example, while I'm recording this video, Bookings app actually has a stock price that's over $5,000 for one single share, while Apple, on the other hand, price is around $250. And this does not mean at all that Booking is worth more than Apple. The price of the stock is just simply what you are buying one single share of the company at. Next, let's take a look at how do you actually make money from the stock market. There are going to be two main ways that you will make money or can make money from the stock market. The first way is going to be pretty simple. That's simply capital gains. That's you buying a stock at a lower price and selling it at a higher price. For example, if you buy a stock at, let's say, $100 and you're able to sell it at a later date for $150, that means your capital gain would be that difference, which is $50. Now, it's not quite that easy, and making the correct picks and knowing when to buy and to sell and to hold is a little bit more difficult than that. And it's important to note that stock prices don't always go up. Sometimes they go down. Sometimes companies go bankrupt, right? But generally, historical trends do show that the entire stock market does usually go up about 8% per year. The second way you can make money from stocks are from dividends. A dividend is an amount that a company will actually pay you if you own their stock for a certain amount of time. Most dividends pay out on a quarterly basis, but there are a few monthly dividend stocks, as well as some that pay annually or on special bases as well. Dividends are one of the true passive income sources because you literally get paid by a company for simply investing your company in or investing your money into the company. Note, it's important that not all companies give dividends. Some dividends are pretty good and they've been paying out for a long period of time, but some dividends are pretty low, or maybe some companies don't give you a dividend at all. Next, we're going to take a look at some more common stock market terms that maybe you've heard of or maybe you haven't. If you've ever heard someone talking about the stock market, you've probably heard them referencing the S&P 500, the Dow Jones, the Nasdaq, and maybe some others as well. These are going to be indexes. The S&P 500 tracks the 500 largest market cap stocks in the US. The Dow Jones tracks 30 of pretty big, well-known companies. And the Nasdaq is pretty tech heavy with companies like Apple, Microsoft, Nvidia, companies like that. If you ever hear someone say the market was up today or the market was up the past week, they're usually referring to one of these three, probably the S&P. We already went over the term stock, but another term you might hear people buying these things are called funds. There's a few different types of funds, and the most popular one currently is an ETF, or an exchange traded fund. There are also mutual funds, which are somewhat popular, and index funds, which are really not popular anymore. But all are funds and usually hold a basket of different stocks for you. For example, ETFs are pretty accessible to beginner investors because you can actually buy them like a stock. So rather than buying all the individual stocks yourself, you can have somebody else, like probably a big company, make an ETF, and you could buy that ETF that holds maybe 30, 40, 50 stocks for you. All funds usually charge a small fee. Typically, ETFs fees are a little bit smaller than mutual funds. And like I said before, ETFs are just pretty easy to get to. You can buy them just like stocks. Some popular ETFs are VU, SPY, VTI, and QQQ. All four of these ETFs actually track some of the indexes that we spoke about earlier. So if you're looking for a way to kind of get into the whole stock market and get a very good diversified portfolio, you could take a look at some of these ETFs. Now, let's take a look at long term investing and really just investing in general versus trading. So, when we're talking about long term investing, we're usually talking about buying and holding good quality stocks or funds. Typically, if you're doing long term investing, you're going to hold that for a long period of time, usually years, right? Some people are holding these stocks for their entire lives until retirement. And on average, if you are investing in a diversified portfolio, you probably historically will make money over time. On the other hand, let's take a look at trading. And just to be clear, trading is not actually investing. Trading is looking at buying and selling stocks or ETFs or options even on a short term basis, sometimes day to day, sometimes hour to hour, sometimes a little bit longer than that. Trading or day trading is typically not based on best practices when we're talking about investing. It is a pretty high risk, high reward strategy, and often over time does not actually pay out as well as investing in a long term strategy. Speaking of risk versus reward, let's take a look at that next. Just to be clear, the stock market is not a savings account. The stock market can be very volatile, which means it goes up and down constantly. But luckily for us, this is normal, and the stock market historically goes up over time. Like I said earlier in the video, it ranges from about 7 to 10% a year on average. Another way to make sure your portfolio or your investment strategies aren't too risky is something called diversification. Diversification is sort of the golden rule of investing. Instead of putting all your money into one stock or one single company, you should invest in a lot of different companies. Now, this video isn't necessarily going over which specific companies to buy. I will be coming out with more channels or more videos on my channel about those types of things. But in this video, we're kind of going over the basics, and diversification is usually a pretty important thing to a good, solid investing portfolio. And the last term or idea that we're going to talk about today is called compounding interest. So, going along with some of the things I said earlier, if you have a long term investing strategy, one of the best things about that is compounding interest. There's entire books and articles and even probably YouTube videos written on the concept itself. But in a nutshell, all it is that over time, your money will continue to make money and it'll have a snowball effect. So that amount will get bigger and bigger and bigger. It'll make more money over time. For example, $10,000 invested at age 30 over 35 years until the average age of retirement around age 65. If we take a look at that at an 8% annual compounding interest rate without adding any money over the lifetime, you'll get almost $147,000. If you're interested in really seeing the power of compounding interest, feel free to try a calculator. There's plenty online. Now, to close out the video, you might be thinking, how do I start investing today? What can I do? And luckily, in 2026, there are less and less barriers to invest, and in some cases, it's actually free to start. The very first thing you're going to want to do is open a brokerage account. There's a lot of different options online. Some companies charge fees, some companies don't, but a brokerage is where you can actually put your money into and buy things like stocks, ETFs, different funds, sometimes crypto, options, other things like that. But right in our case, if we're a beginning investor, we're probably going to be looking for a brokerage that has pretty low minimum or maybe a zero minimum starting fee and also little to no commission trading fees. I personally use a few different brokerages. I really like the Robinhood app. I also use Fidelity for my 401k and a few other investments. And I also use the Acorns app, as well as some smaller investments in M1 Finance and Webull. In the description, I will have a few links to different brokerages. Feel free to check them out. But for beginners, it's usually best, again, to do one that has pretty low fees as well as just really no commissions on trading at all, right? Because if you're a beginner investor, you might not have a lot of capital yet. You don't really want to get charged with a bunch of different fees. But feel free to do your homework. Also, I have in the description affiliate links to sign up for that, which usually means if you do sign up, you get some sort of reward, and I also get a reward. But you don't have to use my affiliate link. But if you are signing up for a brokerage account, I would recommend looking if there are affiliate links because you could get free money for just signing up and depositing some money into your account. So last, a few tips and tricks just for kind of, if you're getting started to investing. Make sure to do your homework, right? YouTube videos are great like this one, but even mine, right? This is not financial advice. This is just educational purposes. Don't trust what people say online or on YouTube, including myself. You really want to make sure you do your homework. There's a ton of free and paid resources out there to help you get started with investing and choosing different stocks and ETFs. Another good strategy is to just invest regularly, right? If you have a certain amount that you want to set aside each week or each paycheck or each month to put in your portfolio, even if your portfolio isn't doing great, you can always continue to put more money in hopes that it will go up over time. And to go along with that, only invest what you can, right? investing these brokerages accounts, these are non-savings accounts, right? You don't want to be taking money out of them. You want to keep the money in it and grow it over time. Other than that, that's really it for this video. I hope you guys enjoyed it. If you did, feel free to leave a like. If you want more videos like this, or if you have any other suggestions, feel free to leave a comment in the comment section as well. If you do enjoy things like investing, personal finance, that kind of stuff, feel free to subscribe to my channel. I will be putting out more videos on a regular basis regarding that type of content. But other than that, guys, thank you for watching.